Yeah, I would like to welcome you to our series of CPA classes. And this being our lesson 1, we are going to begin with financial accounting. And since financial accounting 1 is an introduction, and it is in the CPA foundation level 1, we are going to learn financial accounting at advanced stages as we continue. Now, this accounting information, when you're talking about the fundamental accounting information, who need this information? Who are the users of the accounting information? Why do you as an individual need to know the accounting information of your business organization, of your company, of your employer, of the institution that you are related or you have interest in? One of the user of the accounting information is the government. The government will require to know your information or the accounting information of your business, basically for tax purposes. Although it may also use the accounting information to control things like inflation, yeah, to know the security and the exchange of a country. But the fundamental reason the government may require accounting information is tax purposes. The next person or the next user of accounting information is the employee. Being in an organization, would like to know the going concern of your business, the going concern of your company. How are you sure that your business will be in operation beyond 1 year? So as an employee, you need to know the accounting information so that one, you are able to be guaranteed of a job security. Yeah, because job security in the sense that you are sure that your business or your company is not winding up. It's not closing down the business any soon. Yeah, you need to have the accounting information. The second thing as an employee need accounting information is to know if the business could provide the necessary benefit that is due to them. You might work and then you find that you have 3-month or 4-month salary arrears. So you need accounting information to know how is your company doing. The other category of people that may be interested with accounting information are suppliers and other trade creditors. Of course, as a supplier, you need to know the accounting information such that you can tell whether the business is going to pay you in good time. Does it have enough current assets that can be liquidated very fast to pay your bills or to pay your supplies? So as a supplier, you need to know the accounting information of the business that you are engaged or you're dealing with. As well as customers, client, or consumer. We are seeing that customer need accounting information in order to determine the continuity of a business, most especially when there is a long-term engagement between the parties, or if the customer is dependent on the enterprise. If and a good example is this: if you are a student in a school and maybe it is a 4 years program, and the school depend 100% on the contribution or the fees paid by the student, you need to have the accounting information to know whether the school will be able to meet its obligation. Can it be able to pay the staff, take care of the bills, and you yourself to be in a position to learn comfortably? So customers or consumers require accounting information to know whether the business is going to be there for a long time. Other categories, we have lenders, we have banks. Banks will be interested with accounting information. In fact, before they lend you, they will ask you for your bank statements so that they can ascertain that you have the ability to pay and you will be in a business in a foreseeable future. So you are seeing that lenders have similar need as suppliers, where they interested in accounting information that enable them to determine the ability of the client to pay their obligations and the interest attached when the loan becomes due. Investor and businessmen, of course, investors have what we are calling required rate of return. They start expectation that when I invest my 1 million in this company, I expect that within a short period of time, I will get this amount of money. In such a case, we are saying that investors may require accounting information. Investors and businessmen, investors need accounting information in order to make relevant decisions. Through accounting information, they could determine whether to purchase stocks, sell stocks, or hold the stocks. Public, all of us need accounting information for the business around us. We want to know the status of the economy. We want to know what is happening with our favorite fast food chain. We want to know the status of the retirement plan. Families need to budget their money, monitor receipts and disbursement, and many more. So in our day-to-day life, we require accounting information in one way or the other. Then this information has structures. You don't just require information. There are some things in accounting information that you need to know that are relevant. And then we are calling to give you what we are calling accounting equation. In accounting equation, here we are going to look at what constitute accounting information. And there's a basic accounting equation here we normally have is the amount of asset that you possess in a business must have been financed by something. If you have a tractor, what financed this tractor? Was it a loan? Was it your capital? That means the amount of asset you have must have been financed by other stuff. And you're saying the basic accounting equation is the amount of asset that you possess is equals to liabilities plus equity. Liabilities, they are in two categories. We have short-term liabilities and we have long-term liabilities. Short-term liabilities are those liabilities that last within an year, and long-term liabilities are liabilities that last beyond 1 year. In equity here, we are just referring to the capital of the business. Therefore, the amount of asset in a business must have been financed by liability plus equity. That is an accounting equation. Now, you're seeing, as you can see, asset equal the sum of liabilities and owner's equity or capital. This makes sense when you think about it, because liabilities and equity are essentially just sources of funding for companies to purchase assets. Correct. So you're saying for any business, it has to be financed by capital and liabilities. Yeah. When you get a loan from a bank, that is a liability. When you give out your own money, that is a capital. Now, what are these assets? We have said that assets is equals to liabilities plus capital. So what are these assets? We are saying that an asset is a resource that is owned or controlled by the company to be used for future benefits. Some assets are tangible, like cash, while others are theoretical or intangible, like goodwill or copyrights. So we are saying that assets, they are those assets that you can touch, you can see, like cash, like a motor vehicle. Those are assets that you can see, and those assets, they exist, but you cannot feel it. Yeah. If you're in a business, a business field, and you happen to be operating a butter shop, for instance, a butter shop in a certain location for 4 to 5 years. Within that period of time, people have known that if you want to buy a good shoe, you go to a certain shop. Now, in case you want to wind up, and the amount of stock you have in your shop is 40,000. Yeah, the amount of, if you sell everything within your shop is 40,000, but you sell everything at 100,000, because you are saying, I'm also selling you some of my customers who don't know that I have wind up. The excess money you get beyond the 40,000, that is the worth or the value of your stock, is called the goodwill. All of these assets are resources that a company can use for future benefit. Here are some common examples of assets. We have cash, account receivable, prepaid expenses, vehicles, building, goodwill, copyrights, patents. Now, prepaid expenses, why are prepaid expenses an asset? And I want to explain this with an example. If you are paying rent, rent is an expense. You pay a rent for 1 month. That means at the end of 1 month, you'll have to pay another amount of rent. But if you pay in advance for like 5 months, it means if you live there for 1 month, you decide to leave that premises, the amount of money you had paid for the excess 4 months can be refunded to you. Therefore, it means that is an asset. You paid your expenses earlier before they incur, then they become assets. And we continue with the accounting information. Ask yourself, what are these liabilities? We have seen that a liability in its simplest term is the amount of money owed to another person or organization. Yeah. Liabilities are those things that you have, but they don't belong to you. They are in your possession, but they are not, you don't own them. Liabilities are creditors' claims on company assets, because this is the amount of asset creditor would own if the company is liquidated. Liabilities, they are in different ways. We have a short-term liabilities, like when you go to a bank and take a salary advance. That is a liability because you will pay. If you go and take a long-term loan, that is a liability. Therefore, you're saying that a common form of liability is accounts payable, or accounts payable are basically creditors. Payables are the opposite of receivables. When a company purchases goods or service from other companies on credit, a payable is recorded to show that the company promises to pay the other company for their assets. That means you have purchased goods, but you have not paid for them. Then they constitute accounts payable, or they constitute creditors. In other words, you have some assets with you, but they don't belong to you, even if they're in your possession, until you pay them. Then those ones becomes liabilities. Example of other liabilities are bank loans, lines of credit, personal loans, officers' loan, and earned income. And finally, we ask ourselves, what are equity or capital? Equity represents the portion of the company assets that shareholders or partners own. In other words, the shareholder or partners own the remainder of assets once all the liabilities are paid off. We have said that asset is equals to liabilities plus capital. If you clear all the liabilities, whatever is left is your capital. If you clear all the liabilities, whatever is, in other words, we say that in a simple term, the amount of money contributed by the owner to start the business, we call it capital. Owners can increase their ownership share by contributing money to the company or decrease equity by withholding company's fund. Likewise, revenue increases equity while expenses decreases equity. We shall come into inner details here when we shall be looking at statement of financial position, otherwise called balance sheet. So we shall come to understand more about equity. Here are some common examples of equity: owner's capital, owner's withdrawal, revenues, expenses, common stocks, paid in capital. Now, we shall look at one example. We are saying that let's take a look at the formation of the company to illustrate how the accounting equation work in a business situation. Ted is an entrepreneur who wants to start a company selling speaker for car stereo system. After saving up money for a year, Ted decided it is time to officially start his business. He formed speakers and contribute $100,000 to the company in exchange for all the newly issued shares. This business transaction increases company shares and increases equity by the same amount. Accounting equation here. You have given the company 100,000. Yeah. You have purchased speakers worth 100,000, meaning that you have an asset. Yeah? An asset worth 100,000. But this asset was financed by the owner's equity. These speakers that are what are there, they worth 100,000 and they were purchased by the owner's equity. Therefore, the accounting information here is the asset that we have, $100,000, were purchased by the owner's equity. Therefore, asset is equals to the owner equity. In this case, liabilities are 0. After the company formation, Speakers Inc. need to buy some equipment for installing speakers. So it purchased 20,000 of installation equipment from a manufacturer for cash. In this case, the Speaker Inc. uses its cash to buy another asset. So the asset account is decreased from the disbursement of cash and increased by additional installation of equity. So what happens there? You have reduced your cash, meaning that when you reduce your cash, you decrease your cash, but at the same time you increase your assets. That means you are buying what? Remember, this is purchase of installation equipment. That means all of these are assets. The amount of cash will go down and the installation equipment will come. Therefore, the accounting equation here will only affect assets. There are no liabilities being interfered with here. You are reducing your cash and increasing the assets. So, basically, I want to explain this and say that when we are dealing with accounting information, we shall require to have an inner depth of what are assets, what are liabilities, and what are equity. Otherwise, you are saying that there are those transactions that will affect asset only, like the one we have said. If you take 20,000 from your business to buy a photocopying machine, that is a transaction affecting assets only. That means you have reduced your cash and you have increased your assets. And there are those transactions that affect asset and equity. Like if you have given your business, you have added 50,000 as capital to your business, and you have used this 50,000 to buy a motorcycle, it means that the amount of capital has purchased asset. That is a transaction between asset and liability, no, asset and equity. So we are saying that any increase in asset will be matched by equal increase in equity and vice versa, causing the accounting equation to balance after the transaction are incorporated. That means if you have used assets, if there is an increase in assets, it means either this asset have been purchased by liabilities or they have been purchased by equity. Therefore, an increase in asset means there is a corresponding increase in equity and vice versa. So, since this is an introduction lesson, I don't want to start some computation, but we can have just a simple look at what we are going to learn in the next lesson. So let's look at this example. ABC Limited issue share capital for $2,500 in cash. Before transaction, assets was 10,000, liabilities were 5,000, equity were 5,000. If you take asset minus liability, they give you equity. After the transaction, that means the asset were increased by 2,500, but liabilities were not affected. So the difference between asset and liabilities, they are going to give us equity. Therefore, asset has increased by 2,500. It has gone to 12,500. Liabilities remains constant. It means equity will increase by 2,500. In other words, in an accounting equation, we are, as you have said, an increase in asset will lead to a corresponding increase in equity. Yeah. When we shall be recording this one, we normally call it a double entry rule. We shall be learning this, a double entry rule, that an entry, when you have an entry in one ledger, will have a corresponding entry in another ledger. That means in this case, you said an asset has increased, it has led to a corresponding increase in equity. So the equity 7,500 is brought in by the original capital, which was 5,000 plus an increment of 2,500. So giving us 7,500. So because this is an introduction, as we progress, we shall be doing some computation in depth. Otherwise, kindly subscribe and get ready for the next lesson. Thank you.